This is a challenging time for asset managers. There's fee compression, there's the shift from actives to passives, there's underperformance throughout mutual fund land. How does Natixis respond? What's your strategy?
Our strategy is to remain true to our principles. We're an actively managed firm that really seeks to generate alpha for our investors. We do believe that in a increasingly uncorrelated environment, where the tide is no longer rising for everybody, our strategy is going to make further inroads. We believe, when you see the statistics, that performance will remain key and increasingly key. And as a result, we continue to encourage our managers to think long-term, to think performance, and to be differentiated and not hug the benchmarks. That's really what we believe will be the answer to the future challenges of our industry.
Why active only? Is there no room for a firm like Natixis, with Natixis' size, to compete in passives, or do BlackRock and Vanguard own that market for good?
You know, I'm not saying passive has no place in the portfolios person. It does, and it's going to be here to stay. We want to stick to what we do best, and passive is a game of scale, real scalability, and low cost. We have a totally different strategy. We generate alpha, we charge fees that really demonstrate the value we bring, and of course we try to have a long-term perspective. We build partnerships with our clients. We believe in the current environment, and as investors over time shift to solutions, to products or solutions that are designed to generate certain outcomes, the advisory part of our business will take increasing importance. And increasingly, we don't want to be a product seller. We want to be a solutions provider in partnership with our clients. And that is value for money for our investors, and that's where we have a competitive advantage.
Even in the active business, scale matters, right? It helps to defray fixed costs and to fight fee compression. Is $900 billion enough? Or would more scale help you? Well,
if you look at our profitability right now, it demonstrates that we have a good business. That being said, we're not ignorant of the environment. We are adapting in certain cases to market pressure. We respond to our clients in terms of ability to tailor and properly price our products. But as we think about the future, we're not there to only scale. We're there, first and foremost, to provide performance to our clients. And performance does not necessarily need scale.
I guess what I'm getting at in part is, do you see opportunities to be a consolidator?
We are naturally a consolidator. Our business model, the multi-affiliate business model, is designed to integrate entrepreneurial investment teams that are in need or would benefit from our umbrella, from our distribution workforce, from our ability to help them grow. And that's we're a natural partner for these alpha-generating investment firms. So by definition, we are a consolidator.
But on a team-by-team basis or on a firm-by-firm basis, do you see opportunities for Natixis to participate in the consolidation that we see, for example, with Janus and Henderson or Standard Life and Aberdeen? Do you want to buy other firms?
Listen, we are buying other firms. We bought DNCA 2 years ago, sizable acquisition, and it was a firm with an established brand name, an established team, and a track record. So we are constantly on the lookout for families, investment teams that can join our family. And when I say investment teams, I mean investment firms.
So you have an appetite for more?
It's part of our business model. It's part of our business model.
In France, it's been a bit of a tough time for your business and for asset management in general. Are things turning around enough now that we'll see significant inflows as soon as this year?
Well, you're already seeing some inflows.
That's why I use the word significant.
Yeah. Of course, there was a period of status quo as the uncertainty around the election led people to take a pause. I think now the fundamentals are again coming back to the forefront, as opposed to the political risk overlay that we had the past few months. France is getting traction. Increasingly, the sentiment is positive. That being said, France is a bit on the bottom end of growth in terms of European countries. I think there's a fair amount of hope, of course, as a new president takes office, that things will change for the right result.
Do you need to cut staff to improve profitability?
Our model is not based on cutting staff or cutting costs to the core. We're an active manager. We want the best people. We want to have investment teams that are encouraged to generate alpha for our clients. So our model is not based on that.
What about rebranding? Is there room for that? BNP Paribas rebranded its asset management business.
We have, in fact, a model that is reliant on our brand, Natixis Global Asset Management, as well as the brands of each of our individual investment firms. That's our model, and we don't intend to change that.
Jean, do you share the view that equity markets, particularly the U.S. equity market, are getting a bit frothy?
I would share the view that as we are today, the U.S. market is probably, on a relative terms, more expensive than the European market.
That's undeniable.
That's undeniable. And that's where we think the equilibrium may happen over the next few months.
A shift in equilibrium, how? Because two things could happen, right? The European, let's say we're comparing the European market to the U.S. equity market. The European market stays where it is and the U.S. equity market corrects.
Well, the U.S. market has already corrected a bit. There's a fair amount of hope about tax reform, corporate and the infrastructure spending in the U.S. following the election of President Trump. I think today, as you know, there's a perception that those reforms are not happening as quickly as people would have liked them to be. As a result, the market took a pause, and you see that in many sectors of the U.S. market. In Europe, what held back the market over the past few months was the political overlay risk, and that's Brexit, that's the Dutch elections, that's the French elections. We may have another, at some point, debate as to whether Italy will create further turmoil from a political risk standpoint. So in Europe, there's a fair amount of political risk overlay that has kept, if you want, the fundamentals from the forefront. And we think that as these political risk overlays get subdued, the fundamentals will lead to significant flows in European equities.